It's looking at Beyond Meat, ticker BYND, and that recent pretty wild plus 36% rally.
Yeah, and the analysis asks the right question. Is this a real turnaround or just a short squeeze trap? It concludes, that the fundamentals are still critically weak.
Which, given a 13.3% revenue drop and a huge net loss, makes a lot of sense.
Exactly. The report is very well put together. It nails the key driver, that technical squeeze, and the one big positive, the Walmart deal. But to make it truly essential for the kind of trader it's aimed at, we need to talk about how it communicates risk.
Okay, that feels like the perfect place to start, especially with a stock this volatile.
So the analysis immediately flags an extreme risk, 10-10, in the summary. But this idea needs to be structurally woven into every single point that follows, not just stated at the top.
Right. I see what you mean. It's a really powerful warning, that 10 out of 10, but then the analysis just kind of moves on.
It moves on to the technical targets, the stabilization points, and that's the weakness. The reader sees extreme risk, but then immediately gets caught up in the details of a potential trade, like that $1.60 resistance level.
And psychologically, you start to forget the warning. You focus on the potential upside, on the numbers you can actually act on.
Precisely. The brain just sidelines the severity of that 10-10 risk. It's a cognitive bias, You focus on the tangible path to profit, and the initial warning just sort of fades.
So the suggestion is not to just state the risk, but to use it as a lens?
Use it as a constant filter. You have to editorially embed it into the discussion of any good news. Every positive catalyst, every technical target has to be immediately challenged by the reality of the financials.
Okay, so it's about creating a constant sense of tension in the report. How do you do that without just sounding repetitive?
It's not about repetition. It's about strategic juxtaposition. So, for example, when the report discusses the Walmart distribution win, which is vital.
Yeah, it's their revenue floor.
It is. But right after explaining why it's so important, you have to frame the failure scenario through that 10-10 risk lens.
So not just this is good, but what happens if this good thing goes wrong?
Exactly. What is the 10-10 risk if they can't meet Walmart's volume demands? Or what if the demand contraction we saw in Q3 continues and they lose that precious shelf space? You have to stress test the bull case in real time.
You're forcing the reader to see that the win isn't just a win. It also introduces a new, very high-stakes operational risk.
And you do the same thing with the technicals. When you're talking about that resistance level between 160 and 180, you have to explicitly remind the reader that trying to break that ceiling is a huge gamble. And you don't just say it's a gamble, you anchor it to the specific horrible numbers.
Like the gross margin collapsing to 10.3%.
Yes, or the staggering minus $110.7 million net loss. You tie the technical picture directly to the financial bleeding. It makes the risk feel immediate and quantifiable, not just like a generic warning label.
That changes the question from what are the trading targets to how could a trade possibly survive in this environment?
That's the shift. It elevates the analysis from a breakdown of facts to a truly integrated risk-first report, which is what you need for a stock that's basically in survival mode.
Absolutely. Okay, moving on. The report does a great job outlining the company's big structural change that got rid of that debt ticking time bomb.
Which they had too.
But the cost was, well, catastrophic dilution. The share count went from about 65 million to over 450 million, a seven-fold increase.
And that's the central paradox here, isn't it? They bought survival, but maybe at the cost of all future equity value. So while the report correctly flags this dilution, the analysis needs to explicitly connect the sheer scale of it to what's now required for long-term profitability.
You're saying it needs to go beyond just pointing out the dilution.
Way beyond. The weakness is that it notes that future profits are split among 7x more shares, but it doesn't really quantify what that means. I mean, what level of growth is now needed to overcome that massive financial bleed and satisfy 450 million shares?
The current bull case is just betting on survival.
And survival alone isn't an investment thesis, not with that kind of dilution. An investor is betting on a return. The question isn't will Beyond Meat exist in a year, it's will my shares be worth anything?
Yeah, if future earnings are sliced that thinly, the growth needed to see any positive EPS has to be, almost vertical compared to before.
So the suggestion here is to provide that context, quantify how much the required growth rate has changed. The analysis really needs to challenge the reader. Does this survival thesis actually translate into a viable return thesis?
I could see someone pushing back, though, saying that removing the default risk from the debt makes the company fundamentally stronger, period.
And it does. It makes them more liquid. It removes the immediate existential threat. That's why the stock rallied. That's the survival part.
But liquidity just buys you time.
It just buys you time to execute. It doesn't change the fact they're burning over $100 million a quarter. And now, any potential profit has to be spread across 450 million shares. If they just stabilize revenue, what does that mean for EPS? Probably still negative.
So the core problem is that the reader doesn't have a benchmark. They don't know what good looks like now.
Exactly. So for a concrete example, the report should emphasize that reversing the 13.3% revenue decline isn't enough. Getting to zero isn't enough. They need aggressive, double-digit growth just to tread water on a per-share basis.
The analysis should probably include a rough model.
I think so. Suggest the stress test. If the company does stabilize revenue for the next 2 quarters, what kind of margin expansion would be required just to break even on a GAAP basis with 450 million shares? Give the reader that threshold.
That would really define the scale of the challenge. It shifts the focus from what happened to what is now required.
Right.
Okay, let's talk about the third point. This brings us back to that Walmart deal, but from a different angle. The analysis correctly points out the grim Q3 reality. Shrinking demand and a collapsing gross margin, down to a dismal 10.3%.
And this is where the bull case and the bear case collide in a really dangerous way. The report identifies the Walmart win as vital for stabilizing revenue, but the analysis should explore the risk that this high-volume deal could actually accelerate margin erosion, not reverse it.
That's a critical point. The weakness right now is that the Walmart deal is presented as a bull point and the margin collapse is presented as a bear point. They're treated as separate things.
As if they just offset each other. But what if they're linked? What if one is causing the other? The report doesn't really analyze how the huge volume demands from Walmart could strain that already terrible 10.3% margin.
Securing space in 2,000 stores is great for the top line, sure. But that kind of volume usually comes with a price.
A very steep price, promotional pricing, slotting fees, things that absolutely hammer your margins. They might be buying that revenue floor with their long-term profitability.
That's the hypothesis the analysis needs to dig into.
Yes, the suggestion is to drill down into the mechanics of that deal. Does getting that shelf space demand pricing that crushes their margins even further? Or, on the other hand, will this new BYND IV product with the avocado oil command a premium and maybe protect them?
But that's a big unknown. And even if it does, there's the cost of the new ingredients.
Right. That's another concrete example for the report. Dig into the clean label pivot. The cost of healthier ingredients like avocado oil might be higher. So even if consumers like the new product, the margins might not recover for a long, long time.
Meaning the margin recovery gets pushed out indefinitely, even if they succeed in stabilizing sales.
Exactly. And to really sharpen this point, the analysis should question the primary goal of the Walmart deal. Is it designed to offset that $70 million Q3 revenue drop at the explicit expense of margin?
If the answer is yes, that massively strengthens the bear case.
It recontextualizes the win. It's not a victory, it's a necessary and very costly survival tactic. Connecting those two dots, the distribution win and the margin collapse, makes for a much more sophisticated piece of work.
This has been incredibly helpful. Let's just quickly recap the main opportunities for improvement here.
Yeah, 3 main things. First, really integrate that extreme risk rating throughout the whole analysis. Second, sharpen the investment thesis by quantifying the massive growth now needed to overcome the dilution.
And third, do a deep dive, a stress test, on how that critical Walmart deal could actually put even more pressure on their collapsing 10.3% gross margin.
So the actionable steps are, use that 10-10 risk rating as a constant filter, calculate the new growth hurdle created by the dilution, and really analyze the strategic cost of that Walmart volume.